The market is a total mess right now, and every crypto channel has a different story. Cowen says the latest jobs report was so bad that a Fed rate cut is almost a guarantee now. CryptosRus disagrees, blaming the crash on that report plus new tariffs. But is it time to panic? Crypto Tips says to relax, claiming all the numbers are fake and the money printer is just warming up for Bitcoin. Meanwhile, Lark Davis is asking if the Wall Street ETFs have completely broken the old Bitcoin 4-year cycle, maybe pushing this run into 2026. And while Bitcoin gets all the attention, the modern investor sees big players quietly moving into Ethereum, betting on a massive altcoin season. With so much conflicting information, who are you supposed to believe? In the latest video from Altcoin Daily, the channel claims that the current crypto dip is the absolute last chance for investors to make life-changing wealth before prices skyrocket. The video pulls together arguments from Michael Saylor, Cathie Wood, and Tom Lee to make its case, suggesting you have about a 30-day window to act. The video creates a powerful sense of urgency, but a closer look at the facts raises some questions. The most significant point is the portrayal of Paul Atkins as the new SEC chair. This is not accurate. Gary Gensler is still the chairman of the SEC. Paul Atkins is a former commissioner. The Project Crypto segment appears to be either speculative or taken out of context, yet it's presented as current news and is a foundation of the video's argument for an immediate policy shift. While the bullish predictions from well-known figures like Cathie Wood, Michael Saylor, and Tom Lee are real and reflect their long-standing views, framing them around a non-existent change in SEC leadership is misleading. It seems designed to generate maximum fear of missing out. The price targets mentioned are based on optimistic scenarios, including massive institutional inflows and favorable economic policies, which are not guaranteed to happen on the timeline presented. In the latest video from Crypto Rover, he breaks down why Bitcoin just took a massive hit. He points to a few big reasons: a huge $800 million outflow from Bitcoin ETFs, weak U.S. job numbers that suggest a recession is on the way, and rising global tensions involving Russia and the U.S. He says that while Bitcoin is seeing little bounces, it keeps building liquidity below, meaning it's likely headed for a bigger drop to grab that cash. The next major support level he's watching is around the $110,000 to $112,000 mark. The connections made in the video between ETF outflows, weak economic data, and Bitcoin's price action are pretty standard market analysis. The $800 million outflow is a clear bearish pressure. The M2 money supply is a more debated indicator. While it's true that a contracting money supply can mean less liquidity for risk assets like crypto, the correlation isn't always a perfect predictor. It's one tool among many. The current market feels like a tug-of-war between two big stories. On one side, there's the fear of a looming recession. On the other, there's the expectation that weak economic data will force the Federal Reserve to cut interest rates, which historically has been good for assets like Bitcoin. This mix of fear and optimism is likely what's causing the intense volatility we're seeing. In the latest video from the Crypto Tips channel, the host tells everyone to relax about the recent market downturn. He points out that while the stock market lost a massive $1.11 trillion, Bitcoin is actually down less than 10% from its all-time high. The real story, he argues, is that the U.S. economy is in trouble and the numbers we see are completely fabricated. He references a tweet from the Kobe's letter showing that President Trump fired the Commissioner of Labor Statistics after job reports for May and June were revised down by a huge 258,000 jobs. The host calls this whole situation theater and says that government policies like tariffs are not bringing jobs back. Instead, they're going to make people poorer and fuel massive inflation. This is where Bitcoin comes in. He explains that the Consumer Price Index, CPI, the government's inflation number, is misleading because it doesn't include food or fuel, hiding the true rising cost of living. As the Federal Reserve is forced to print more and more money to deal with a stalling economy and potentially fund things like universal basic income, that inflation will make assets like Bitcoin soar. He believes the money printer is just getting started and that the crypto space will go ballistic. His plan is to ride out the bull market and sell around 30% of his Bitcoin to have cash ready to buy more during the next bear market. It's interesting how the video channels a sentiment that many people feel: a general distrust of official economic figures. The speaker's point about job numbers being revised is valid. These reports are often subject to significant changes after their initial release. This argument about inflation is also a common one in crypto circles. While the main CPI figure actually does include food and fuel, the core CPI, which is what news outlets often focus on, excludes them. This nuance is often lost, and the video effectively uses that confusion to build its case for Bitcoin as a hedge against what people are actually experiencing with their wallets. The connection between government spending, money printing, and the appeal of a scarce digital asset is the fundamental story of Bitcoin, and this video presents it in a direct, no-nonsense way that resonates with its audience. In the latest video from Lark Davis, he tackles the big question on every crypto investor's mind: when is the right time to sell? He lays out a few popular theories to help narrow down when the market might top out. First is the classic Bitcoin 4-year cycle, which is tied to the halving. Historically, the market peak happens over 500 days after a halving event. If that pattern holds, we could be looking at a peak between September and late October 2025. Another way of measuring by weeks between cycle tops also points to late October. However, a growing number of people think this cycle is dead now that Wall Street is involved. The huge influx of cash from Bitcoin and Ether ETFs, with US Bitcoin ETFs now holding over 6% of the supply, has changed the market structure. Experts like Bitwise CEO Matt Hogan and CryptoQuant CEO Ki-Young Koo argue that factors like interest rates and a shift from old whales to new institutional whales are now the real drivers. This leads to the idea that crypto might follow longer stock market cycles, which could push this bull run into 2026 or even later. Raoul Pal from Real Vision also thinks the cycle could extend into 2026, lining up with potential changes at the federal. Ultimately, Lark suggests that instead of trying to perfectly time the top, a better strategy is to have a plan. He recommends reverse dollar cost averaging, selling small amounts as prices rise, especially if you're sitting on life-changing gains. Lark does a great job of laying out the central debate roiling the crypto space right now. The idea that this time is different is usually a red flag, but the data he presents makes a strong case. The market hitting a new all-time high before the halving this year was a major sign that the old 4-year cycle playbook might not apply anymore. It seems the constant demand from ETFs is creating a higher price floor and changing the market's dynamics. The theory that crypto is now more tied to global liquidity and macroeconomics rather than its own internal clock feels right. The old cycles were driven by a relatively small group of early adopters and retail traders. Now, with major financial institutions in the game, it's behaving more like a recognized global asset. While the historical patterns are interesting, relying on them completely feels like driving while only looking in the rearview mirror. In the latest video from the Cowen channel, he breaks down the newest labor market report, and it's not looking great under the surface. While the unemployment rate ticked up to 4.2%, the real story is in the revisions to past months. Job numbers for May and June were slashed, with May's additions dropping from 144,000 to just 19,000, completely changed market expectations. The probability of the Fed cutting interest rates in September shot up from 39% to over 80% right after the report came out. Cowen's analysis of the hidden weakness in the jobs report is really sharp. Focusing on the massive downward revisions is key, as the headline number doesn't tell the whole story. The market's reaction, with rate cut odds for September jumping to over 80%, confirms just how significant this data was. His theory about AI's impact on hiring feels increasingly valid. We're seeing more anecdotal evidence in company reports about leveraging AI to reduce the need for new hires, especially in tech and creative fields. This isn't just a temporary dip caused by interest rates. It might be a permanent structural change in the labor market. The Fed is caught between a rock and a hard place. If they cut rates to boost a weakening labor market, they risk letting inflation get going again. If they hold steady to fight inflation, the job market could get a lot worse. It seems like the path of least resistance is to cut, but that might just be a short-term fix for a much deeper issue. In the latest video from the Coin Bureau channel, Guy breaks down why the crypto market crashes. He explains that it's not just one thing, but usually a mix of a major economic event and a crypto-specific problem, all made worse by leverage. He starts by explaining how leverage works in crypto trading. When you trade with leverage, you're borrowing money to make bigger bets. This can lead to huge gains, but also massive losses. A small price drop of 20% on a 5x leverage long position can get you liquidated, meaning your position is automatically sold. This creates a chain reaction called cascading liquidations, where one sale triggers another, pushing prices down fast. He suggests using a free tool called CoinGlass to see if a crash is being driven by these liquidations. My take on this is that the video's focus on leverage as the primary accelerant for crashes is spot on. We see it play out constantly. Just recently, the market saw significant liquidations after a slight downturn, proving how sensitive prices are to leverage positions. The distinction between macro fuel and crypto sparks is also a really useful way to think about it. Right now, everyone is fixated on the Fed's next move, the monetary policy catalyst, but the point about fiscal policy, the relentless government spending, being the bigger underlying river of liquidity feels incredibly relevant. It seems to explain the market's strange resilience at times, even when the news looks bad. It's a reminder that while a specific crypto catalyst might trigger a sell-off, the bigger economic picture often decides if it's a short-term dip or the start of something worse. In the latest video from the CryptosRus channel, George explains why today was a complete disaster for the markets. Bitcoin dropped under $113,000, altcoins crashed, and the U.S. stock market took a nosedive. He points to two main culprits. First, a terrible jobs report that came in way below estimates. What's worse is that the numbers for the last 2 months were revised down so drastically that it basically means there's been zero job growth for 3 months. George finds it suspicious that the data could be so wrong, suggesting the numbers might be manipulated to fit a narrative. The second reason for the drop was Trump's announcement of new tariffs on Canada, 35%, Brazil, 50%, and Switzerland, 39%, which added more fear to the market. The video does a good job of connecting the dots between poor macroeconomic data and the market's reaction, which is a classic financial dynamic. The idea that bad news for the economy can be good news for assets is all about Fed policy expectations, and we're seeing that play out right now. The speculation around the Fed governor's resignation is particularly interesting. While political pressure on the Federal Reserve is a constant and very real theme in Washington, a resignation tied directly to it would be a major story. It feeds directly into the core argument for cryptocurrencies like Bitcoin that a decentralized, programmable monetary system is a desirable alternative to one influenced by political drama and last-minute policy changes. The whole situation just reinforces the narrative that the traditional system is unpredictable, which is why many people are looking for an exit in the first place. In the latest video from Crypto Banter, we get a raw, behind-the-scenes look at the company's intense work culture. It's all about one word: winning. The team describes the Banter culture as a high-pressure, fast-paced environment where you either have it or you don't. It's about pushing yourself to limits you didn't think were possible and being brilliant or nothing. The video centers on an exercise introduced by the founder, Ran, after he returned from vacation. He asked every single team member to rate their own performance on a scale of 1 to 10. This simple question sent a wave of stress and strategic thinking through the office, with people debating whether to rate themselves high and seem arrogant or low and seem lazy. Ran uses a famous story about Steve Jobs, who once fired an entire team, even though they were his second best, to avoid creating a culture of resentment after they were beaten by another team on the iPhone project. Rand's point is that protecting the culture is the most important thing. He tells his team that anyone who rated themselves a 9 or 10 is either delusional or not hungry enough. This exercise forced everyone to be honest about their performance and what was holding them back, leading to a renewed sense of alignment and excitement to get back to being the best in the world. This video is a fascinating piece of brand building. It positions Crypto Banter as more than just a media company. It's a high-performance machine with an almost cult-like devotion to winning. The move to show internal vulnerabilities and the pressure cooker environment is a strategic one. It humanizes the brand and creates a narrative that resonates with their audience of ambitious crypto enthusiasts who are also looking to win in the markets. By pulling back the curtain, they're building a deeper connection and loyalty that isn't just tied to their market predictions. It feels less like a corporate update and more like an episode of a reality show designed to make the audience feel like they're part of an exclusive, hardworking club. In the latest video from Crypto Wendy, she tackles the recent fear and doubt surrounding XRPL's low transaction volume. She explains Ripple executive David Schwartz's response, which is that major bank partners prefer to settle transactions off-chain due to compliance and financing rules. While Schwartz admits on-chain adoption has been slow, he believes a change is on the way. The video points out that XRPL saw a 30 to 40% drop in new wallets and transactions in the first quarter of 2024, though its DeFi activity was stronger. Wendy then gives an update on the Ripple versus SEC lawsuit, noting that we should hear something around August 15, 2024, when the SEC has to report to the appeal court. On a more positive note, she mentions that Coinbase is launching Nano XRP perpetual futures on August 18th, which should boost liquidity. Also, a 2x XRP ETF from a company called Ethereum has already attracted over $300 million in flows, taking up 52% of its market and showing strong investor interest. Wendy dismisses an article about XRP losing $22 billion in market value, saying the whole market is just quiet and that she's confident in the long term because the team is constantly building, and a recent report shows 90% of finance leaders see a big future for digital assets. The whole debate around on-chain versus off-chain settlement is a classic one in the XRP community. It really gets to the heart of what Ripple is trying to build. While the purists want to see everything happen on the public ledger, the reality is that traditional financial institutions move slowly and value privacy above almost everything else. Schwartz's explanation seems plausible for that world. What's more telling, though, are the developments happening around XRP. The new perpetual futures on Coinbase and the massive inflows into that European 2x XRP ETF show that the financial infrastructure for XRP is being built out, regardless of the on-chain metrics. It suggests that serious market players are getting their tools ready, which is often a much stronger signal than short-term transaction volume. The SEC case continues to be a long shadow, but these kinds of product launches prove the market isn't just sitting around and waiting for the final verdict. In the latest video from The Modern Investor, the conversation is all about the growing buzz around an altcoin season and how Ethereum is right in the middle of it all. The idea is that if Ethereum does well, other altcoins tend to follow suit. There are some big predictions floating around, with some people calling for Ethereum to hit $7,000 to $10,000 by this September or October. A major reason for this optimism is the shrinking supply of ETH on exchanges, which is apparently as low as it was a decade ago. On top of that, nearly a third of all Ether is now locked up in staking. The video really zeroes in on a trend that feels more and more real every week. This isn't just hype from crypto influencers, it's a calculated move by serious financial players. The mention of companies like BitMine and BitDigital shifting their strategies to focus on Ethereum is telling. It looks like they're trying to get a major foothold before the rest of the market fully wakes up to Ethereum's role in the next phase of digital finance, especially with stablecoins. This all lines up with the bigger picture of major asset managers like BlackRock and Franklin Templeton filing for spot Ether ETFs. It seems the smart money isn't just betting on the price. They're investing in the infrastructure itself, and they're doing it now ahead of potential regulatory approvals that could open the floodgates to even more capital.